under some pressure, this market. So once again, it's resumed its downtrend. The Nifty down about 50-odd points. But as we wind down the earnings season, it's a good time to take stock of the internals of the various sectors, and FMCG is on our radar. While FMCG saw some resounding successes and a few nasty surprises, there was no reason to believe that the great Indian consumption story is under threat. Mangalam Malu joins us now with the key themes that played out this quarter. Mangalam, over to you.
Resounding successes and a few nasty surprises, and no reason to believe that the great Indian consumer story is under threat. So this is how the third quarter panned out for the FMCG sector. Two key themes that played out. From the top line perspective, the festive season, Diwali this year, was in the third quarter as against pre-Diwali sales in the second quarter in the previous year. So that aided the top line. However, the margins, they were impacted by higher priced raw material inventory that the companies carried from the previous quarter. So those were the two key themes that played out. Here are the few standout performances. We had double-digit volume growth coming in from Hindustan Unilever as against expectations of 6 to 8%. ITC cigarette volumes too surpassed expectations, margins notwithstanding. Asian Paints, 22% volume growth, much above what the street was expecting. Similarly, we saw Dabur as well outpace what the street was working with. A couple of nasty surprises on the downside. We had Britannia, volume growth disappointed, as did Marico, Emami, as well as Godrej Consumer. Godrej Consumer was perhaps the lowest of the lot in terms of volume growth, coming in at just 1% versus expectations of 5 to 7%. Three results that stood out this quarter. The first one was Titan, where the jewelry business was the one that glittered and the stock moved from strength to strength, currently at a record high. The second one was Jubilant Foodworks. Out there, the street was worried about same-store sales growth. That came in at 14.6%. Margins came in at a seven-year high, but the aftertaste of the pizza wasn't too good with regards to the royalty payment hullabaloo that took place on the promoters. We have Bata as well that reported the numbers yesterday. Very, very strong set. Nearly 450 basis points expansion in the margins. That stock too at a record high. One other theme that stood out was the companies chose their market share over margins, top line over margins. So we had a big growth in most of the companies' top line, while the margins did come off on account of the higher raw material inventory that they were carrying, and perhaps they chose to gain market share when the demand sun was shining as against worry about little profitability, because going forward we have a few triggers. The first one is crude is now off highs and currency is off lows. So this should aid margins going forward. The platform for innovation and premiumization, modern trade, that one is outpacing the other traditional channels. That's a positive. And rural markets, they're growing faster than urban markets. Add to that, further fuel was added by the government budget and the steps that the government is taking to boost consumption. The minimum support price hike on crops will give people more money in their hands, income tax rebate, as well as the announcement of the universal farm income will give more money in hands of people with more propensity to consume. So all of that is a structural positive for the sector. But the big question, how much of it is in the price? Well, this looks like the batting order of a tall Indian cricket team. Most of the top players having half centuries. So most of these FMCG companies trading upwards of 50 times 1 year forward earnings, and the ones which are not trading are the ones which are not delivered on their numbers as well. So there is a lot of capital which is going to quality and making it a little more expensive. But for the companies which have some structural headwinds, regulatory for ITC, as well as growth and promoter concerns for Emami, trading at 27, much below what the sector average is.
All right. Thank you very much for that comprehensive analysis of the numbers. Of course, most of it is in the price. So what we are going to ask today of our experts is, how is the current quarter and the current year shaping up? And we have two very eminent minds. Sameer Shukla, the RMS leader at Nielsen India, joins us, as does Naveen Kulkarni, Head of Research at Reliance Securities. Gentlemen, thank you very much for joining us. Let me start with you, Sameer. The presentation was very comprehensive from Mangalam, but just tell us, what is the qualitatively the quality of consumption? We see some companies like massive Hindustan Unilever with a massive base throwing up volume growth of 10%, and yet we have a Godrej Consumer, equally marquee brands, with a volume growth of 1%. Is there a problem with the consumer at all, or is it just a brand issue and some are doing well and others are not?
Thanks, Lata. So while we're talking about some of the big FMCG companies, and just for clarity, if we just take out tobacco out of this entire equation for a minute, while you talked about some of the big companies, But equally important and interesting to know is, in 2018 full year, Jan-December, what we realized is the FMCG industry grew at about 13%. But what we see is the smaller players, those, the long tail, which contribute to about, say, the bottom 20% of the entire industry value, was growing at double the pace of the top 50, if I say so. So there's a huge dynamism happening on the long tail also for the industry. And when I say long tail, this constitutes about 40,000-50,000 odd FMCG companies. So that's one point. The second point is, while if you see in terms of headwinds and tailwinds, we have seen that in 2018, there were a lot of tailwinds, and some of your, the analysis that we just heard a while back, we're also talking about a lot of tailwinds that the industry has enjoyed. What we foresee is going forward, there are a couple of cautions that may have to be seen very, very closely. So starting from, on the positive side of all those rural impetus and the government initiatives, but at the same time, we know that monsoons have not been that great this year. And Rabi crop, in terms of especially gram production and all, is going to be under stress for sure in the coming season. Now, while the government has got adequate stock at FCI godowns, but how does it play across in terms of actual production is something which is going to decide a lot on how the industry is going to play. Now, why I'm linking this to the FMCG industry is, especially for the food commodities and categories there, if the input costs, and we have already seen that the input costs have started inching up in the last one quarter, if that goes further up, it will have, say, a lot of stress in terms of pricing and the price action that the manufacturers will be forced to take. And if we do that, it may have a slight impact on the overall consumption growth that we were seeing in the industry, which is buoyant in the last few quarters.
Okay. That point is taken. Naveen Kulkarni, the head of research of Reliance Securities, is also with us. Naveen, hi, morning. I don't know if you were listening to my colleague Mangalam, but he said that one of the big takeaways from the earnings season this time is a lot of companies are now ready to push volumes and top line at the cost of margins, whether it's Asian Paints, Kansai, Berger, Pidilite, etc. What did you make of that? Would that be a bit of a concern?
So, see, if you look at India as a market, it has always been a volume story, and companies that have managed to grow volumes, so those companies have eventually managed to get a higher multiple and have managed to grow revenues higher than the industry, right? So that has been the story. So if you look at, let's say, the re-rating of Nestle actually started when the company's actually strategy changed more towards volume-led growth, right? So that has been a very, very structural story for India. Companies that have focused on volume and market share have done much better than the companies which have focused primarily on pricing actions and maintenance and sustenance of margins. So they have eventually lost out. So that trend will continue because we are still a market where branded consumption, there is still a lot of leeway and there is still a lot of scope for growth going ahead. So I don't see any change in strategy per se for companies going ahead.
Okay. Well, Samir, to come back to you, I don't know why you worried so much about food prices going up, because I thought the worry of the government is that food prices are not going up. We are reporting negative food inflation, fall in prices year on year for a goodish bit. And the last inflation reading also was a decline of 0.7% month on month. I mean, there is no inflation here. Severe disinflation, and some may say deflation. So to come back to how you assess 2019, also, if you can give us some color about urban and rural, more because in rural areas, supposedly this income transfer that has been announced should put a little more money in the hands of the poorest.
Yeah, you're right. So when I was talking about inflation in general, if we see all projections for 2019, even starting from the current quarter, all different projections are that inflation is going to inch up. Now, coming to the foods part, and that's where I was linking to the agricultural production. But in a way, it's interesting to see going forward, because the food stock that the government has maintained over the last couple of quarters has been pretty decent. So that's an interesting play going to be. Apart from that, other, say, input, say, cost, including crude or maybe palm oil, will be interesting to see, because we have seen some upward action on these commodities in the recent time. So that's something which is we'll be closely watching on. Coming to the urban versus rural point, and we have been discussing about the rural markets have been outpacing the urban growth as far as FMCG industry is concerned. And what we saw in the 2018 full year, that the rural growth was 4 percentage points higher than the urban growth. Now we know that urban India still consumes about 2/3 of the entire FMCG consumption, but rural, both in terms of headroom and in terms of the growth performance in the past, has been much better than urban. In 2019 also we expect a similar kind of performance. Rural growth will definitely be higher than urban, maybe a couple of points higher. So these dynamics are interesting to be seen. So for the full year of 2019, what we project is the industry will be growing a tad lower than what we had in 2018. So 2018 the industry grew at about 14% in nominal value terms. In 2019 we're projecting the industry to grow at about 12 to 13%, maybe 1% or 2% lower than what we had in 2018.
Okay, that's interesting. Can you throw a little more color on the incremental gain in volume coming in from which pocket? I mean, you spoke about rural versus urban, but there's also this talk about how, you know, tier 2, tier 3 cities are seeing a higher amount of premiumization than the larger cities, the semi-urban that we call it. Rural rich is a concept that's picking up quite a bit right now. Any more color, any more research that you guys have done?
Yeah, so something interesting in that area, what we saw is, and if we divide the urban India into 3 parts, the metros, the metropolitan, which are more than 1 billion population, about 50 odd towns in the country, and then we go 1 lakh to 10 lakh population, and then smaller than 1 lakh population towns. What we have seen is the 1 lakh to 10 lakh population towns are actually showing a much better growth, definitely better than the metropolitan growth that we have seen. So that's one analysis that we have. The other one is, as big manufacturers on FMCG are expanding and making their direct distribution and reach towards rural areas, we have seen that the smaller towns are not growing at that big speed, because some of these smaller markets, smaller towns which were working as feeder markets, they have actually started losing out because the manufacturers have started having direct distribution to the bigger villages and the rural area directly. So that's something which we are seeing. So 1 lakh to 10 lakh population class and rural India has been seeing the maximum growth in the last few quarters, and the same trend hopefully will be continuing in the next couple of quarters too.
Okay. Well, finally, I wanted to ask you, Sameer, you know, there used to be a complaint about market researchers and consumption experts like you all that the branded FMCG companies are only piercing the top quintile of the Indian consumer. Is there any progress towards the second quintile? How much of the second quintile is active consumption target for FMCG companies?
Well, I think what we see here is FMCG as an industry has got a huge reach, and the reach is actually going up only. What is adding to this, to the advantage for the industry is the channel play. So earlier we had a much bigger focus on traditional trade, the channels on the grocery or the pawn shops and the chemists, which were still having, say, about 89% to 90% kind of contribution of FMCG sales. What we have seen is modern trade channels in the last 1 to 2 years have started growing much faster. Last year, 2018, modern trade channel was growing 2x the rate of the traditional trade channels. And we all know e-commerce is also coming in. E-commerce is also maybe at a very small base, but actually growing very fast. So the point which is interesting here is all the 3 channels, in a way, are complementing to each other in terms of having the right kind of reach. Whichever quintile that we talk about, whichever cohort of consumer and location of consumer that we want to talk about, these channels are having an interesting play, and manufacturers are taking full advantage of this interplay.
Then we have to end with some advice for the stock markets. Naveen, what are you betting on? As Mangalam was pointing out, everything that's done well, like a Bata or a Dabur, are all pricey stocks. 50 times for Bata.
Yeah, so that's true. So, but see, if you look at the earnings growth trajectory, that also continues to be very, very strong. So if you look at, let's say, Hindustan Unilever, for the next 2 years, they will deliver a 20% plus earnings growth, right? So that means the stock, even though it's trading at 50 times earnings, but there is still a decent chance that they will deliver a 10% plus kind of a return on a CAGR basis for the next 2 years. right? So if you look at, let's say, Jubilant FoodWorks, they are growing at a pretty fast pace. The stock would be relatively cheaper compared to the sector. So there is scope for the stock to do well from the current levels. Asian Paints, there's a lot of scope for operating leverage gains coming through in the next 1 to 2 years because of the plants which have gotten commissioned in this year and the cost which is already sitting in the books right now, and as revenues come in, so the operating leverage will start kicking in. So these are some of the names where the earnings growth trajectory is going to be fairly strong, and of course Titan. So I believe that while the multiples are quite high, but considering the earnings growth trajectory is going to be stronger, I believe that these stocks will deliver a decent positive return of 10% plus over the next 2 years, which I believe is pretty decent in the current market situation and circumstances.
Okay, well, gentlemen, we'll have to end the discussion on that note. We've run out of time, but thank you so much for enlightening us about how to approach the FMCG space. Well, with that, it's curtains down on Bazaar. There's still a red hue on the screen. The Nifty is down about 50 odd points, but as we wind down on Bazaar, we leave you with some snippets from an exclusive chat. Shireen caught up with Uday Kotak, the Executive Vice Chairman and MD of Kotak Mahindra Bank, who says that lenders should have been far more cautious when they saw the first signs of a sharp rise in promoter pledges. Thanks for watching.
The whole debt levels against promoters' shares requires two parts to it. And first, I believe from an underwriting point of view, the system should have been far more cautious, where the percentage of shares pledged by promoters started going up about 50 or 60% of their total shareholding.
When you say system, who do you mean?
The lenders. Therefore, if the total promoter shares is 100, if the pledge levels started going above 50 or 60%, there was much lower cushion for safety. And in many cases, we have now seen that the pledge shares are as high as 70, 80, and 90%. So that is water levels being extremely high. But at that stage, you really need to look at the underlying business. And if the underlying businesses are strong, some of these need to be restructured and refinanced in a much smarter way than what the marketplace has done so far. What has happened over the last 2 years is NBFCs were allowed to finance at 2x cover. There was no such regulation for mutual funds. So mutual funds were lending at 1.3, 1.4 and 1.5x cover. So this arbitrage which happened between NBFCs financing against shares and mutual funds financing at lower margins is the reason why levels of leverage also went up.
So is there a need for regulation, or is there a need to review the regulation, especially when it comes to mutual funds? Because that debate is now back on the table.
My personal view is that we should avoid gaps in between different institutions in terms of what are the levels of safety from a margin point of view.
Okay, so harmonize
Harmonize it.
Okay.
So either allow 1.5 times for all, or whatever that number is, between entities, we should ensure that there is some level playing field.